Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. It's the 21st of September 2023 and here are the questions we will be answering today. Why don't Indian women have a fair share in the economy? Are Indian OEMs shying away from the biofuel push? Can the rally in PSU stocks run out of steam soon? And what is the Five Eyes Alliance? The United States took over 140 years after ratifying the Declaration of Independence to give voting rights to women. In the UK, women fought for a century for it. But in India, women got in the queue to exercise their right to vote the year the country got independence. Indian voters also gave the world one of the first elected women heads of state back in the 1960s, Indira Gandhi. But despite all the progress, women's political rights have not translated equally into economic gains for them. Kasturi Akhil finds out why Indian women don't have a fair share of the economy.
If all goes as the ruling BJP has planned, the first bill to be turned into a law in the new parliament will be the Women's Reservation Bill. It has been passed by the Union Cabinet and is being debated on the floor of the House. The bill seeks to reserve 1/3 of the seats in Lok Sabha and state assemblies for women. After tabling the Nari Shakti Vandan Adhiniyam, or Women's Reservation Bill, Prime Minister Narendra Modi said it will strengthen democracy and further our resolve of women-led development. Currently, India has 78 women MPs in the 545-member lower house. It is about 14% of the total membership. And the government wants to make it 33% now. But does this ratio reflect in other spheres too? According to the Centre for Monitoring Indian Economy, India's labour force participation rate, or LFPR, declined to 39.5% in the financial year 2023 from 40.1% in FY22. The participation rate for men stood at 66%, while that of women was pegged at a mere 8.8% in financial year 2023. The LFPR is the share of the working age population that is employed or is looking for work. The periodic labour force survey for Jan-March also indicates a similar trend where female LFPR across all age brackets has been significantly lower than males. Further, as per International Labour Organization data, India's female LFPR stood at 24% in 2022, lower than its South Asian peers like Pakistan at 25% and Bangladesh at 38%. At 24%, India's female LFPR was also lower than its BRICS peers and the G7 economies in 2022. Even Bangladesh and Pakistan were ahead of us. A host of reasons have been cited for this. Conservative societal norms and gender pay parities are a few among them. Safety concerns, inability to take action against harassment at work, or inaccessibility to sectors that are mostly male-dominated, like manufacturing, also pose barriers to women entering or retaining employment.
So things have definitely become better, but I can say that they are not really again the best, because if you look at a recent judgment, it's a May 2023 judgment. Over there as well, the Supreme Court has observed the same thing, that most women don't report, they would rather leave the job. So, and this we are talking about 2023 observation. So the majority of the segment of the society still does not feel comfortable to report it, because there is so much stigma and just the sheer amount of, I think, challenge associated with bringing up a concern, which could be a lot to do with even the mental pressure that it might take on a person. Along with that, all the taboo and everything else that might come from society as well.
A recent report pointed out that the overall regular wage employment fell substantially during the pandemic year 2020-21, wherein women accounted for 50% of the jobs lost. Formal jobs, however, as a share of regular wage work, increased parallelly. Yet, women constituted only one-third of the said increase. Meanwhile, media reports revealed earlier this year that of the 2,041 companies listed on the National Stock Exchange, only 100 have women as a managing director or a CEO.
This is symptomatic of what really happens with women who, even if they're joining at the entry level, because of various reasons, again, society, commute time, family issues, and sometimes employers, they opt out. When it comes to career progression, it's very difficult for these women after a break of 5-10 years to come back and make up for that loss in the corporate ladder. More often than not, that's why you're seeing that while even if you're improving the entry level diversity, the mid and senior level is getting compromised.
A 2018 report by ILO revealed that around 82% of the total working women in India are concentrated in the informal sector. A lot of surveys analyzing women's participation in the workforce failed to capture the extent of women's participation in the informal economy, and therefore much of the work they engage in, like domestic work, construction, street vending, etc., goes unaccounted for.
The first step is, keeping gender aside, can we unleash a formalization tsunami in the economy, which essentially uplifts the conditions, status, stature, dignity of everyone, including women? And it's a fact that because labor mobility for men is higher than women, that's the reason you will find women choosing to stay back in their villages, and they end up taking up a lot of the informal work.
Women participation in the workforce has indeed improved over the years. Several initiatives by the government, like the 4 labor codes, will help women in the informal sector. But the new laws are still hanging fire and are unlikely to be implemented before the upcoming general elections. Experts, meanwhile, argue that women's economic mobility requires a multifaceted approach that addresses challenges on all fronts, whether socio-economic, educational, or political.
The transition has been slow, but women's voices will hopefully be heard more in all the corridors of power. India, meanwhile, is witnessing another transition. It is trying to phase out fossil fuel. The country recently launched the Global Biofuel Alliance during the G20 summit. The demand for a departure from fossil fuels has never been louder. But is this transition happening the way the government had originally planned? And are auto majors as excited about the idea as the government? Abhijit Kumar brings you the answer.
India's push towards biofuels is grounded in its desire to reduce its carbon footprint and reduce its dependence on fossil fuels. The government's ambitious target is to achieve 20% ethanol blending in petrol by 2025-26. The announcement of a global biofuel alliance at the recently concluded G20 summit showcased this seriousness. But the numbers reveal a grim picture. According to the International Energy Agency, despite India being the 3rd largest producer of ethanol after the US and Brazil, its contribution to the total global biofuel procurement in 2022 was just 2.7%, or 4.6 billion litres out of the total 171.2 billion litres. India's Pet Green initiative has been historically slow in achieving its targets. It is only after the 2018 National Policy on Biofuels that led to increased funding and improved technology, which raised the blending level to 10.17% in July 2022. Currently, the blending stood at 11.7% in June this year, with the government saying it is well on track to attaining 12% by November 2023. However, E20 petrol, which is a key component of the blending target, isn't still easily available. The Petroleum Ministry informed the Parliament this August that E20 petrol was available only in 1,900 out of the 72,079 fuel stations across the country till August this year. At the heart of the government's biofuel drive is the flexible or flex engines. These engines are designed to run on a variety of fuel mixtures, including ethanol and petrol, or biodiesel and diesel. As of today, Toyota is the only automaker in India that has introduced flex fuel engines in one of its models, the Corolla Altis. According to the data from the Ministry of Road Transport and Highways, since 2018, only 32 fully ethanol vehicles have been officially registered in the country, out of which most have been two-wheelers. However, the number of petrol-ethanol blend vehicles show better promise. As per the Vahan portal, vehicles running on the petrol or ethanol blend were 1,94,214, almost all of which have been sold since January. Shamasis Das of the think tank Center for Social and Economic Progress shares what is holding back Indian OEMs from turning to flex engines despite the government's promises.
So for India's industry, which is production-based, a market that has potential for consistently large sales volume and rapid scalability are important to take an investment call. Now, with respect to flex fuel engine market, auto players have some ifs and buts in their mind because on their investment or portfolio horizon, they already see other technologies emerging or gaining traction, like we know battery electric.
So what are the potential challenges that are making Indian automakers hesitant to embrace the biofuel push? Puneet Gupta of S&P Global Mobility argues that several factors like the cost of retrofitting existing vehicles to accommodate flex engines and concerns about the consistency of biofuel supply in India contribute to the auto industry's caution.
There is a lot of volatility around, in terms of policy making. You also need to have a supporting infrastructure. You need to have pumps giving ethanol. You need to have the ethanol production.
Industry insiders also believe that the high cost of flex engine cars might drive customers away.
The automakers might have also envisaged that flex engine vehicle price is going to be higher as compared to a conventional IC vehicle. So will the customers be ready to shell out more? And also, there are a few question marks on the long-term performance of flex engine because we know that ethanol has some corrosive property.
So is regulation the way to ensure automakers' compliance?
I will agree with it partly because once the regulations come in, then every OEM has a roadmap because importing of oil is one of the national challenges.
But a few experts fear that additional compliances may burden the auto industry.
Already, India's automobile market is going through an enormous transition from internal combustion engine to electric vehicle. This could actually add another maybe complexity. The government can recognize flex engine vehicle as a zero emission vehicle and allows the automakers to consider this technology to fulfill that ZEV compliance if such mandate comes tomorrow. Because a separate compliance requirement just for flex engine may not be really liked by the industry because that could be burdensome.
Automakers' trust deficit in fuel transformation remains a significant challenge. Regulatory clarity from the government and easier availability of ethanol blend petrol in the future can bring back confidence among the automakers to meet India's biofuel ambition.
Let us now turn to financial markets. Shares of public sector enterprises are on a bullish ride, but with the gains comes valuation worries for some. So can these stocks run out of steam and how should you pick those that may still have it in them? Harshita Singh finds out in our next report.
शेयर मार्केट में रुचि रखने वाले को भी ये गुरु मंत्र है कि जो सरकारी कंपनियों को ये लोग गाली देना आप उसमें दांव लगा दीजिए साहब अच्छा ही होने वाला है.
This remark of PM Modi last month might have been a jibe at the opposition, but PSU shares have become a rather serious affair for Dalal Street investors. Shares of public sector enterprises have been on a bull run this year, led by optimism around government capital spending and the indigenization theme. The BSE PSU index has rallied 25% so far in 2023 as against an 11% gain in the Sensex benchmark. Though in recent months, it's the PSU banks that have been leading the charge with gains of up to 52% in the last few weeks. On the other hand, while defense and railway PSU shares have also given stellar returns on a year-to-date basis, some underperformance has been witnessed in recent weeks. Analysts suggest a stock-selective approach for the PSU basket as only select undervalued pockets still have room to gain more.
Each point of time there is some sector which is doing it. Previously, the rally started with PSU defense stock. It was followed by PSU railway stock. Now the stocks, where valuation comfort is there and which are very attractive are seeing a rally. In that space, PSU banking has huge value. Where valuation comfort is there, I think one has to look at those stocks and sectors. So PSU bank, the PSU banks have not done much. So there is a comfort. Coal India, for example, NMDC or few other stocks where valuation comfort is there.
While healthy asset quality and strong credit growth is drawing investors into PSU bank shares, the high-performing defense and railway PSUs are now pricing in valuation worries.
So in the last 2 weeks, PSU defense and railway stocks have taken a bit of a breather after a very sharp rally over the last 6 to 12 months, where the valuations are now really out of the whack and taking into account even 3-year, 4-year forward earnings. As compared to that, PSU banks PAC is significantly undervalued. PSU banks have cleared their balance sheets and ready to fund the growth of the Indian economy for the next CAPEX cycle.
Echoing this, analysts at Kotak Institutional Equities said that they are not sure about the future profitability of defense companies and the stocks are ignoring potential risks of order win delays and entry of private players. On the other hand, those at ICICI Securities note that the Nifty PSU Bank Index has seen a resolute breakout from a decade-long consolidation. Similar breakouts in many PSU bank stocks signal a sharp acceleration and a structural turnaround in coming months. Thus, it would be wrong to paint the entire PSU basket with the same brush given the mixed outlook. Investors hence should keep a stock-specific strategy. Today, on September 21st, the global market's reaction to the US Fed policy outcome and commentary will guide equities back home.
He's making plans for an early retirement. Business Standard.
But the markets didn't look perturbed by the face-off between India and Canada. Experts think it will have little impact on Canadian investment in India. Some reports claimed that the killing of a Khalistani separatist was raised privately by various officials of the Five Eyes Alliance in the run-up to the G20 summit, but it was not made public. Now, what is the Five Eyes Alliance? Boris Pradhan explains.
The Five Eyes is an intelligence alliance comprising Australia, Canada, New Zealand, the United Kingdom, and the United States. It was formed in 1946. The alliance is based on a series of bilateral agreements on surveillance and intelligence sharing. These arrangements are commonly known as the United Kingdom, United States Communication Intelligence Act UK-USA Agreement. The UK-USA Agreement was so secret that its existence wasn't even acknowledged until 2005. Each of the Five Eyes states pursues interception and decryption activities and shares all intelligence information obtained with the others by default. The information is shared through the ultra-sensitive Stone Ghost network, which has been claimed to contain some of the Western world's most closely guarded secrets. The countries agree to exchange all signals intelligence they gather by default. The bedrock of the Five Eyes Alliance is based on the joint abilities of the United Kingdom's Government Communications Headquarters, GCHQ, and the USA's National Security Agency, NSA, to intercept intelligence. These agencies collect and decrypt signal intelligence called SIGINT, which involves internet, telephone, radio, and satellite data from across the world. During World War II, informal secret meetings between British and American codebreakers laid the groundwork for establishing this alliance. After the Cold War, the information sharing arrangement became formalized under the Echelon surveillance system in the 1960s.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The Canadian Pension Plan Investment Board has significant holdings in some Indian companies. These stood at 1.74 trillion rupees about a year ago. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.